Okay, and now look at this point here. Market went low, started trading up, forming in form of what? Resistance here. Price trading away from it. Now most retail traders will be engaged in the market somewhere here. This is the first touch, second touch, this is the third touch. This is where they will be entering the market. Okay, they will enter the market here, hoping to either target this low. Okay, either target this low or even aim lower and continue the movement down to the next support zone. Okay, that is the textbook narrative of trading support and resistance. But being a smart money trader, I know that I can see a supply zone above this resistance. So all I need to do in today's video, we are going to continue the series of liquidity inducement theorem, okay, in forex. You can use this also in crypto, you can use it in stock. So what is liquidity inducement? This is a situation whereby the market gives you reason to buy or sell. By so doing, you are building liquidity for the big banks to cash in and then move the price. What happens is that the market tricks you to believe that the market will go a particular direction, but end up stopping you out early and then moving that your intended direction. And today's video, we are going to look at how support and resistance do not help you become profitable, because those are areas of liquidity and is a form of inducement that tricks you into buying and selling. So first of all, what is support and resistance? So support and resistance are simply areas on the chart where price has touched several times. What it means is that when price return back to this area in the future, you can decide to engage in the market. So for example, when the price returns back to this area of resistance here, it is known that the retail traders those that trade the retail logic will come in here to sell down to this point, and as price touches the support, the market will simply move out from that. Okay, but in reality, these do not play out just as the textbook suggests. Why? Because what is happening in all these areas here, what is happening here is simply liquidity being built, okay, so that smart money can come in, clear this liquidity, and then continue going the opposite direction. So those people that have orders here, will put their stop loss above. Okay, this is where their stop loss is, and this stop loss is also an order. It's simply a kind of buy order. If you are selling, it's a buy order. When price comes back, it takes you out. Okay, and those that are buying at support are building liquidity for the market, and these are all liquidity inducement. The market inducing you to trade, making you believe that since the market has touched this level before and moved up, came back, touched this and moved up, that the third time will be a charm, and the third time the market will move. But in most cases, what we realize is that since your stop loss is below, the market will take the stop and in form of a stop hunt and then move to the other direction. So I'm going to share with you on the chart different examples, both bullish and bearish scenario, where these do not play out. And what should you be doing instead? What I used to do instead is simply, when you identify area of support and resistance, what you need to do is to look above the resistance, look below the support for a demand and supply zones, because those are the zones that initiated the original move, and therefore price needs to come back to mitigate these demand and supply zones, okay, in order to take the price to the opposite direction. Now, what is the purpose of this liquidity inducement here? Is to validate the supply zone. When I see support and resistance zones below a supply zone, for example, if I see resistance below a supply zone, I will know that this whole thing was engineered. Okay, the market printed it. The market didn't go straight to the supply zone, okay, before moving. It trade close to it, reverse, trade close, thereby printing liquidity. This is called liquidity engineering. Okay, this tricks people, especially those that are afraid that the market will leave without them. FOMO, they will FOMO in, okay, in order to catch this trend, because based on all your analysis, the market is bearish. Everyone knows it's bearish, but not everyone profits from this, because if you enter early, the early sellers will be taken out with this move to the upside, and then price move in your direction. So what you need to do is simple. When you identify this, look above. If you see any form of supply zone in form of an order block, in form of the breaker block, whatever you are trading, okay, all you need to do is be patient. Price will sweep this liquidity, grab all this liquidity. There will be a liquidity grab into this area to push price to the downside, and all you need to do is to trade that reaction. For you to hold this price up to this point is up to you as a trader. I'm only telling you what you should be expecting in the market. So the rest is all about trade management. How do you manage your trade to this point? Okay, same thing with support. When you are in a support zone, when price is in a support zone, okay, you have to look below to see areas of what? Demand. Why do you need to look at area of demand? So that price will sweep this support, clear all these stop losses in form of a stop hunt into this region, and then you move. This is very quick series, okay? Now let's look at the example here on the chart here, and these are trades that I took. Okay, now we all know that the Euro USD has been in a downward trend for a while now. Okay, and now look at this point here. Market went low, started trading up, forming a form of what? Resistance here. Price trading away from it. Now most retail traders will be engaged in the market somewhere here. This is the first touch, second touch, this is the third touch. This is where they will be entering the market. Okay, they will enter the market here, hoping to either target this low, okay, either target this low, or even aim lower and continue the movement down to the next support zone. Okay, that is the textbook narrative of trading support and resistance. But being a smart money trader, I know that I can see, being a smart money trader, I know that I can see a supply zone above this resistance. So all I need to do, so what I will do is I will simply wait for price to tap in here. Either I enter with a confirmation, or I enter based on risky entry. This supply zone here is valid. Why is it valid for me to take a trade? Because I have a form of liquidity inducement, okay, before it, and therefore makes it a high probability to take that trade and then follow the market. And as you can see, market came up, took out all this liquidity, tap into the supply zone, and there she goes. Okay, same thing here. You can see it created another form of what? A drop-based drop formation here. So before price could come back, it created a form of liquidity inducement here, inducing early buyers, those who are afraid that the market will leave it without them, to be involved, and thereby creating liquidity in the marketplace. Okay, and for those, some people trade the support and resistance as a zone, so probably they might mark all of this as a zone where they will be engaging the market. Second, third touch here, they will take a trade. Some of them might be profitable, but what happens? Price that took them out, trade into this supply zone, created a form of what? Change of character here. This is their entry. You can enter here or wait for a confirmation. This is the confirmation here. So price decides to what? To move. This plays out every time on the market. So to put the odds in your favor, you just need to understand how to spot liquidity inducement. You can spot them by seeing a trend line, which I've covered. If you have not seen it, I'll put it up in this card here, or check the link in the description. Okay, and then secondly, it can be in form of what? Support and resistance. In this case, this is a form of what? Support. Price trading here on the support, in case you are trying to trade a pullback. Sometimes even though we know the market is bearish here, you can decide to take what, a pullback trade. A good example is to use liquidity inducement theorem, meaning that you will know that some people will be in here already. You know some people will be in here trying to take this market probably up to this point here. Probably up to this point here, but they are in it too early. Okay, so what you need to do is to wait for the market to sweep out this liquidity, create in this form. You wait for a break of structure, because if you look at the left, it will be too far. You can't see nothing here. Okay, but I believe in the higher time frame you see the demand zone. But in case you don't see, all you need to do is wait for confirmation in form of what, a break or change in order flow, or what you know as what, a change of character, to take this price to the upside. So this is where, after the liquidity has been taken, you can take your trade off this order block. Yeah, okay, you can take your trade off this order block, then market moves to your target here. Okay, and that is that. Also, even if you look at all this order block here also created a form of what, demand. When price came back here, went up, came back here, early buyers here, if you don't manage your trade well, it will take you out. So you can see market came back here, sweep this liquidity, this inducement. When I see this, I know, okay, it's time to buy. So market took that out and went all the way. Okay, and even if you look at this form again, this is another example. This is another example here. In this case, we have a demand zone here, market building liquidity. These are engineered liquidity. They were not there before now. So you have to be very careful. Even if you are buying here, you have to be very careful to know that the market might engineer the form of liquidity, especially when it stops in this form here. You can be trading this range here, okay, because this is a good supply zone to sell from. So market came back down. When you see this, I will be wary in buying here, because we have equal lows here. So buying on this order block is wrong. So in this case, this order block will not hold, because the order block is sitting at the pool of liquidity. So what happened? Price came down, clear it into the demand zone. These are what, support level, where a lot of retail traders will be involved in, and their stop will be what, taken. Market created what, a break. Okay, a change in order flow. If you don't enter here, you can enter on this confirmation to take the price to the upside. You can see it happens everywhere if you can monitor the chart very well. And sometimes it might not just be in form of multiple levels. It could be just a single weak movement. Okay, so looking at a recent example here, this is another example here. Market took out this, went up, but in this form is trying to create what I call what, a pullback into area of what, where you can short. I took this short today, being 20th of July. I took it. I'll put the screenshot there. Did I even record? I took a trade there, and then I exited the moment price trailed below this, because I know that once it's, from my analysis here, once it's getting to 1 o'clock Nigerian time, New York open, the market may decide to come up or consolidate. So I don't want to involve my profit in here. So I took it out. If I see any form of liquidity inducement here, probably inducement before this level here, I will be involved in the market. Maybe a form of liquidity engineered in this form like this. Okay, I'll know that, okay, this level should be able to create a reaction, and see if the market will go to the downside. How strong is that reaction, or will it trade up above here? Because this is a stop point. Okay, market cleared all of this trend line liquidity. Okay, break to the downside. I did a video on trend line liquidity. This must have been your entry, and for those that missed this, that's why most time when you over refine, it's not good. Those that miss this, I wonder what they will do. So that is what I want to show you today: support and resistance. Don't just trade it blindly, okay, because the disadvantage of support and resistance is that it's not a particular line, okay. It's very subjective, it's vague. You might not even understand why price is even moving up and down in those levels. So what you need to do is look above for a support, for a supply zone, look below for a demand zone, and trade off those demand and supply zones. And that case, you have a very good, winning percentage in your trade. You will be stop out less often, and you have more of a winning trade. And if you want to understand and make sure that you follow me, you can be part of the YouTube membership, where every week I do a kind of workshop. When you join the Dragon Superlord, I do workshop every week. Okay, every week we do a workshop for the week. And if there's any urgent idea that I have, I can certainly also share. And it's only for those in the membership. So make sure you join. And if you are watching this channel, you are not yet subscribed, kindly subscribe to this channel. Okay, take this channel to 10K before the end of the year, if possible. Take to 10K. We are a beautiful family in here. Okay, now to understand more on liquidity, I will see you in this video.